Very good morning. Namaste. Very good morning, everyone. How are you? All good? Audio video set? Let me know. Audio video all clear? Very good morning, everyone. All right. So, as you can see, today we are taking the editorials of 3rd, 4th, and 5th July. Okay? 3rd, 4th, and 5th July. So, it will be covered till today, and from tomorrow onwards, I will try taking up the classes regularly so that we do not have a backlog for that. Okay, long time. Yesterday we had classes. Shreya, you were not there. Anyways, so yeah, that there was a gap in between. I understand your curiosity. That's good. It is a sign that you all are curious to learn. That is a good thing, but you should not be tensed. Leave it on me. Okay, I'll not leave anything important which is important for you. So finance and economy editorials of 3rd, 4th, and 5th July we have. So today we have two editorials basically, right? Two editorials. So first one is, all right. Just a second. All right. Before starting with this, let me tell you 2-3 points. So first, we are having these kind of articles in the newspapers that what should happen in the budget, what should come into the budget. So I'm not taking up those because what happens in the budget will be discussed after the budget is released, right? Second thing, financial stability report related articles. Although today we have one of them, but it is not exclusively related to financial stability report. Only data has been derived. So some references have been taken to authenticate the analysis. I found that interesting and relevant other than the as compared to the other articles. That's why I chose that article. Okay. Next thing. So these are, if you read these articles in the newspapers, don't worry. They will be covered in the financial stability report, and when the budget comes, so budget part will be covered. Okay. So I'm screening out to avoid any repetition. Okay. One doubt, should we follow editorials till the exam, rather do it from the compilations? It's up to you. You can watch these classes. They will be more than enough. We are easing your work. Why do you have to spend your time? Your time is precious. Okay, your time is precious. I'm screening out all the relevant articles for you, so you just can rely on the classes. It would reduce your time, and also you would not compromise on your preparation, right? So first article which we have today is from the business line of 3rd July. The business line of 3rd July. So it is regarding, as you can see the title, good shape, bad shape. Good shape, bad shape. It is regarding stability in the banking sector as well as in the NBFCs. So what does this article is talking about? Let's discuss. So let me give you a hint. Basically, we have covered these things in the RBI annual report, that banking sector is performing good on the front of liquidity, isn't it? Banking sector is performing good on the front of liquidity, but NBFCs have a strain. So this article basically tries to assess, are banks risk free literally, actually, or there is a bubble being created? Is it a hype? So what is the actual reality of banks liquidity, plus what is the threat to NBFCs? Is it more harmful, or is it more vulnerable to liquidity crisis? So all these questions will be NBFCs. All these questions will be answered. So this is from the business line of 3rd July. Now you can see here, banks are in robust shape. Fintech NBFCs need watching. So basically this editorial talks about banks being stable, but you need to have a watch. You have to have a clear regulation for NBFCs. This is what the editorial talks about. Let's see what the author says. That's why good shape, bad shape. Good shape is for banks, bad shape is for NBFCs, right? Okay. So what is it? What the author needs to, what the author talks about. So author says for many quarters now, banks have been reporting a consistent decline in non-performing assets and comfortable capital buffers. And they have comfortable capital buffers. So you know that for a quite long period of time, we are having decline in the NPAs in India. Yes or no? Right? You know that. So banks are recording decline in the NPAs. Also, they are having comfortable capital buffers. That is good. That is good. But the main question is coming in the analysis. This has given rise to doubts. So the author is concerned about something, that is it really the exact situation, or is it somewhat a blurry kind of a picture? So the author says that this has given rise to doubts as to whether there is an unseen bubble building up in the banking sector, or is it really the case, right? So this is the question the author wants to answer, that you all know banks are performing good on the NPA front, but is it a bubble or a reality? This is the main concern of the editorial. Now then he says there has also been concern about bank credit growth running well ahead of the deposit growth. Why is it a concern? Because you have been able to reduce the NPA level. That is good. That is good. But another concern raised by the author is bank's credit growth is outpacing, or it is running well ahead of the deposit growth. Right? So bank's credit growth is more than the deposit growth. Why is it a concern? The author is asking, is it really a concern, or is it good for the banking system in India? Okay. Unseen bubble up, did not understand. Unseen bubble, you know, this is this terminology used in the financial markets in the banking sector. So you have heard that in financial market, this bubble is building up. If you are following the newspapers, there are speculations that in 2025 there will be a more severe financial crisis or stock market crash, severe than the 2008-9-1. Right? You have heard all these news. So this is bubble. Bubble means when you have something very exaggerated and it does not have real solid foundations. Understood? Understood, Tanya? Okay. So this is the thing. Now, the question here, the editorial and the author puts it, is bank credit growth, which is ahead of the deposit growth, a concern? Now tell me one thing. Do you think if a bank, if I give you a situation that there is a bank, or there are a lot of banks in the economy, their credit growth is more than the deposit growth. So they are lending more than what they are, what available deposits they have. Is it good, or it has certain risk? Tell me quickly. Is it good, or it has certain risks? Yes, anyone? Does it has risk, or is it risk free? Risky. Why? Yes, because if you are extending credit without having, very good, without having enough deposits, that would question your liquidity stability, or stability in your liquidity management, isn't it? Yes, you will have to manage more provisions out of your profits. Very good. It has risk. So that's why the author is concerned that it is also something going on with the Indian banking system. So is this fall in NPA really something for which we should congratulate the banking system, or is it something kind of a bubble being created? So now you have understood what we will be going to talk about. The Reserve Bank of India's latest financial stability report. So as I said, this has something to do with the FSR. Latest financial stability report for the 6 months, seeks to allay these fears. But we have these fears in the market going on, but the FSR, the recent financial stability report, has data which provides insights that, you should not be worried about these fears. They are just fears, they are not actual realities. Okay, this is the thing. So is this clear to everyone? So we have two questions. Is this fall in NPA really good, or there is a risk in terms of higher credit growth higher than the deposit growth? Let's move further. What does the editorial has to say? Then the author says that banks are sitting on multi-year low gross NPA of 2.8% and net NPA of 0.6% with no signs of emerging stress in their SMA-1 and SMA-2 accounts. So according to the stability report, financial stability report, so the data shows that you need not worry about this. Okay, data shows that you need not worry about this. Why do we not need to worry about this? Because the gross NPA as well as the net NPA, gross NPA as well as the net NPA have seen a decline. Okay, so gross NPA stands at 2.8% and net NPA stands at 0.6%. Now what is the difference between gross and net NPA? So which one is the real picture, net one or gross one? So try to understand this concept as well. So when I say gross and net NPA, when we say gross NPA, what is gross NPA versus net NPA? NPA is something which you all know, right? NPA is something which you all know. So it is non-performing asset or the bad loan. Now what happens is, you all know there is something called provisioning. So banks have to set aside certain percentage of their profits in order to create a buffer to meet any NPA kind of a situation, right? Yes. So when you do not calculate, when you do not minus the provisions you have made out of your profits, then it is termed as gross NPA. But when you minus the provisions you have made out of your profits from the NPA, from the gross NPA, it gives you net NPA. Okay, so gross NPA is entire NPA with the banks with provisioning, whatever provisioning amount you have set aside. Net NPA is gross NPA minus provisioning. You all know what is provisioning, right? So banks are required to keep certain percentage of their profits for these risky loans to meet the risk. Understood? Everyone, yes or no? The difference between gross NPA and net NPA. If you have understood, now quickly tell me. Okay, understood? Now so quickly tell me, which one is the real indicator of NPA, gross one or the net one? Gross NPA or net NPA? Tell me. Net. Yes. Why? Because it is actually not gross, net, because it shows apart from the provisioning which you have, actual risk what is accruing to your banking system, not gross. Why are you saying gross? Try to understand, it is net, because the provisioning you have set aside, you have subtracted the provisioning amount out of the gross NPA, so that much you have as buffer, but actual risk which is there is in the net NPA. So it reflects the actual risk in the banking system due to NPA, isn't it? Have you understood, right? So this is the thing. Now you see, gross NPA is 2.8%, net NPA is 0.6%. That is a good thing, isn't it? So net NPA effectively should be less than the gross NPA because you have reduced the provision amount from this, isn't it? So this is the thing, right? So after looking at these facts, now you see there is no need to worry about the capital adequacy or the liquidity condition of the banking system. Also, there are no signs of emerging stress in the SMA-1 and SMA-2 accounts. The author says that there is no stress or there is no sign of worry on the SMA-1 and SMA-2 accounts as well. Now, what are these? So, you have asset classification. We have seen them in the previous classes as well. We have asset classification, right? In asset classification, the asset classification happens in broadly 3 categories. So, you have standard assets, okay, then you have SMA, then you have NPA, or performing assets, SMA and NPA, right? So in SMA, special mention account, these are something performing good. All the loans which are performing good, there is no case of default, no risk of default on these loans are your standard ones. But then you have SMA, special mention account. What are special mention account? Special mention account are those for which you have certain period of defaults. So they are in a risk of becoming NPA. This category is your special mention account. Okay. Then special mention account is divided into 3 categories: SMA-0, SMA-1 and SMA-2. In SMA 0, the default period on that loan is up to 30 days. Up to 30 days. So in SMA 0, the default period is up to 30 days. In SMA 1, it is say 31 to 60 days or 30 to 60 days, but effectively 31 to 60 days. And then in SMA 2, the default period of these loans is 61 to 90 days. 61 to 90 days. So this is what SMA 1 and SMA 2 means. Understood? This is what SMA 1 and SMA 2 means. So all those who have a default period in between 31 to 60 days and 61 to 90 days, this also does not have any risk. So why are we fearing about the NPA condition of the banks? So these data show that, you know, there are no signs of emerging stress in SMA 1 and SMA 2 accounts. Now you are clear about this, right? Next, the author says it presents empirical data. Empirical means scientific data, okay, field-based data, scientific data, to show that credit deposit ratios or defaults are not a big worry as long as the credit growth stays within the 16 to 18% range. It was 16% in May 2024. Now, since second question posed by the author was that, you know, credit growth in Indian banking system is outpacing the deposit growth. Credit growth is outpacing the deposit growth. That is a concern. But the author says that this credit growth being more than the deposit growth is not a concern until you have a credit growth within 16 to 18%. So it is not a big issue that can be curtailed, that can be managed basically. Okay. If it goes beyond that thing, or, you know, credit growth is much higher than the deposit growth, then it makes a question. Then you put a question mark on the liquidity management, because then it would threaten your liquidity management. Okay, so this is an ideal range which is considered suitable, 16 to 18%, as per the macroeconomic performance of India going on, right? So generally 16% to 18%, that is not worrisome. Understood? Not worrisome. Also, we have data that shows in May 2024 that has been around 16%. So another question of the author answered here. Okay, another question answered. So we need not worry about that. Okay, so it is not a bubble. It is not a bubble for the banks. It has certain, you know, fundamental reforms which have been done, fundamental regulatory norms, supervisory norms by the RBI have resulted into these things. Active regulation by the RBI. So there is no bubble kind of a thing in banking sector. This is reflected from all these facts. Are you able to understand that, right? Okay. So now moving ahead, what the author says next is that, you know, it puts scheduled commercial banks through a battery of stress tests on macroeconomic shocks, a spike in defaults and so on, to find that they are in very little danger of falling short of capital or liquidity in high stress scenarios. Okay. So now the author says that it puts the banks on a stress test. Is it really less stressful, or do they have a higher stress on their assets? Okay. 16 to 18% growth from previous year or out of total activities by bank, ma'am? No, not from previous year, not from previous year. 16% credit growth recently, not from previous year, overall activities. Okay, so we are comparing credit growth from the deposit growth here. Okay, deposit growth, the growth of deposits which we put in with the banks, right? So we are comparing these two things, not comparing with the previous year level. All right. So now the author says that it puts scheduled commercial banks through a battery of stress tests. So now we need to have a stress test. Are these banks, are these assets of the banks under stress or not? Okay, then the author says banks reported sequentially lower net and gross NPAs of just 1.2% and of 2.1% on their retail books in the March. With the stock market investors relying on borrowed funds, there were concerns about whether a stock market crash would destabilize banks. So now author says there is need not worry about this stress So banks will pass this stress test. Why? Because the retail book. So now you know there are these two kinds of books, trading book and banking book in the banking system. So in banking book, they record all their long-term fixed kind of assets like your loans, mortgages and fixed income generating assets, right? In banking book. In trading book, they have short-term, higher risk related assets like your G-Secs, bonds, all these things. So this is the difference between trading book and banking book. Have you understood this, right? So in banking book, banks record all your long-term fixed, less risky assets like loans, mortgages, fixed income sources. In trading book, you have these assets, financial assets like securities, stocks and all. Then you have something called retail book. So retail lending is what? When banks are dealing with the customers, individuals, consumers, consumer banking, also known as consumer banking or retail banking. So that shows, if we are saying that, you know, in their retail book, the gross NPA is 1.2%, net and gross NPA respectively are 1.2%, net is 1.2, net should be less than the gross, right? And 2.1% gross NPA, that shows that there is lesser risk from the public, right? Lesser risk of default on the front of the individuals. So consumer lending is also safe for that matter, right? All right, so we will discuss someday how many books are there. That is something, you know, should be covered in accounting and all. So yes, retailers, individual, consumer related lending. Understood? So another thing, before this thing, we have seen the general gross NPA, general net NPA. Here we are looking into retail one. So the banks dealing directly with the consumer lending or individual lending, they also have a very less NPA, net 1.2, gross 2.1. So we need not worry about that. But the author says, but now there is another concern raised here, that with the stock market investors relying on borrowed funds, stock market investors are also relying on these borrowed funds. There are concerns whether a stock market crash could destabilize banks. So this is another question posed by the author. We have seen Indian banks performing well, all these indicators which I have discussed with you. But another question in front of you, since these investors which are there, they are also relying on the borrowed funds for investments in the stock market. If stock market crashes, whether the Indian banking system will destabilize. Is it a threat? So this is another dimension with which the author wants to answer or look into. Are you able to understand that, right? So everything clear till now? Yes or no? Shall I move ahead? Right? Okay. Now let's see what then the author says. So the author now is saying that, you know, the stress test showing that 55% drop in stock prices would reduce bank CRAR only by 51 basis points dismisses these fears. So, you know, recently we have seen that the author highlights for a need of stress test. What kind of a stress test? So, a stress test shows that this is not the case. Even if there is a fall in the stock market prices, or even if the stock market crashes, that is not going to affect the banking system very, you know, substantially. That is a good indicator. So we need not worry about that. And what is the figure provided by the author? Author is saying that, you know, 55% of drop in the stock prices. Even if stock prices decline by 55%, that is a huge percentage for the stock prices to decline, isn't it? 55% decline in the stock prices, if we consider, just for an example, this is a data based study, okay, it would reduce banks CRAR only by 51 basis points, which is, how much is 51 basis points in terms of percentage? 0.51, yes or no? Right? So only this much decline will happen in the bank CRAR. In the banks, CRAR. What is CRAR? Capital to risk weighted asset. So CRAR basically is your capital adequacy ratio, which we have discussed n number of times. So bank have to keep, it gives you, yes, itna less. So it gives you an idea how much capacity do the banks have to absorb these kind of risks which are unprecedented, unforeseen, they can happen at any point of time, right? So this is the thing, CRAR or the capital adequacy ratio is maintained by the banks. So it gives you the idea how much adequate capital banks have in comparison to their risky assets, right? What is the formula of calculating CRAR? So it is tier 1 capital plus tier 2 capital divided by total risk weighted assets of the banks. Tier 1 capital plus tier 2 capital divided by total risk weighted assets of the banks. You all know, right? Basel norms. So presently, how much do you need to maintain for the banks in India? According to Basel norms, it is 8% or 9%. But what is the RBI's guidelines for the CRAR presently? Okay, very good. So, very good, very good. Alright, so you understand what is CRAR. Now you tell me, so we have this data in front of you, even if the stock market prices decline by 55%, you only have a 0.51% decline in your CRAR. That means you have enough capital adequacy, isn't it? You have a robust capital adequacy. Yes or no? Yes, right? So this is the thing. So now we have answers to all these questions. Now you have understood that these are the various dimensions we should be concerned about for the banking system. But actually this is not a matter of concern, but we should look upon all these indicators regularly to check whether the banking system is performing well or not. Simple. Now the story does not end here. So we have had passed, so banking system of India has passed the stress test. Yes or no? Yes, with the flying colors, right? With the flying colors. But now the stress test is on the NBFCs, non-banking financial companies. So author now questions the liquidity capacity, absorbing capacity or risk absorbing capacity of the NBFCs. So it must be remembered that, you know, it is not banks but non-banking financial companies that have been at the forefront of lending to both new and below prime borrowers of late. So the author says, abhi NBFC baki hai. So the author says, you know, it is not the condition with the bank. So the concern does not lie with the bank. Concerns lie with the NBFCs. Why are we saying that NBFCs, we need to be concerned about the NBFCs? Because NBFCs have been at the forefront. They have been actively lending to new borrowers as well as, you know, subprime or the below prime borrowers. What is subprime lending or below prime lending? So, you know, prime borrowers which who have lesser risk of being lesser risk of defaulting. And then there is subprime lending, subprime borrowers. When you lend aggressively, even when the borrower has a higher risk of default on the loans, no, they maintain CAR. Remember, there are a lot of provision for the NBFCs as well. But what the question we are concerned with in this editorial is, they are engaging in subprime lending. Remember this word, subprime lending. So subprime lending mein there is higher risk. Prime borrowers are those which have lesser risk of defaulting. So if you are being engaged actively in lending to those borrowers who have a higher risk of defaulting, that means you have a higher risk of NPA, isn't it? Right? So that's why NBFC is the concern. Risk could lurk there. So author is saying risk is not in the banking system. Risk is in the NBFC system or in the NBFC ecosystem, right? So you have to monitor strictly the NBFC's lending. Are they involving in evergreening? Why are they lending to the subprime borrowers aggressively? All these questions need to be answered. Otherwise, this good performance of the banks, you know, will be outpaced by their mistakes. These kind of activities done by NBFCs. Subprime lending, I told you, when you borrow aggressively, even without assessing the exact risk, you give aggressive loans to those borrowers as well, those entities as well, who have a higher risk of defaulting. Okay, higher risk of defaulting. So this is the thing. Now moving ahead, author says, prompted by the regulatory tightening in November, NBFCs slowed their pace of retail lending. So now you know NBFCs have been under very strict regulation of RBI for the last few years of time, right? So author is saying, prompted by regulatory tightening in November, NBFCs slowed their pace of retail lending. They have slowed their speed of retail lending. Again, retail lending. Directly you are dealing with the customers, consumer lending, right? You have understood this term? Now, and trimmed the share of unsecured loans. They have also reduced their share of unsecured loans. These kind of loans which have a higher risk of default, they have tried to shrink it down, okay? Unsecured loans in their books from 32.2% to 22.9% while reporting NPAs below 2%. So it is due to strict regulation by RBI that they are concerned. Now they have reduced their unsecured loan from 32.2% to 22.9%. Also, NPA has been below 2%. Also, NPA has been below 2% for the NBFCs. But then what is the concern? But the author is saying that, you know, RBI's recent regulatory actions against some NBFCs after inspecting their books show that the reported numbers may hide evergreening and underreporting of stress. So these numbers are quite satisfactory that you have below 2% of NPA. So you say, what is the risk in the NBFCs? So the recent reports, regulatory actions against NBFCs and the inspection of their books, their accounts, has revealed this thing, that this figure might not reveal the actual picture. There is something they are hiding. There is something they are hiding, right? So there is something fishy going on, right? What is the fishy? What fishy is there in their books? That they might be hiding evergreening of loans and they are underreporting their stressed assets. They might be hiding their evergreening of loans and they are underreporting their stressed assets. What is evergreening? You know, evergreening of loans, when you reduce the rate of interest for the borrowers who have not been able to pay, right? In order to hide your NPA, hide your stress. Why do these entities try to hide? Because if they have higher NPA, they have to keep more provisions out of their profits, isn't it? Why are they hiding? It is something not beneficial for them if they have huge NPA, but they are hiding because then their provisioning percentage increases. They have to keep more out of their profits as provisions against these risky loans. Have you understood this? Not all figures are from the stability report, but some of them are. But all of them are from the authentic sources only, RBI based, okay? So that's why evergreening, you all know, giving loan for repayment of the loan, right? All right. Okay, so you will tell me now. This is your question for the next class. Note it down. What is the CRAR requirement for commercial banks? What is the CRAR requirement for cooperative banks, if it is, right? What is the CRAR requirement for urban cooperative banks and all these categories, and also for NBFCs, if it is there? You will try find out these figures and you tell me tomorrow. Okay, we will discuss them tomorrow. So now focus on this. You have understood that they are underreporting these NPAs. Underreporting. So there is this concern going on. That's why we are concerned. Is it a bubble or a reality? Okay, this is the thing. Now, moving ahead. So the author says, while overall defaults on retail loans have dipped, overall defaults on the retail loans provided by NBFCs have declined, you know, but those for loans below 50,000, those loans below 50,000 rupees, they have remained elevated. Also, fintech NBFCs account for 47% of this pie. All these loans, default on loans below rupees 50,000, which have elevated, maximum share out of them, or say around 47% share out of them, is of fintech related NBFCs, or financial technology related NBFCs who are involved actively in the fintech market. Okay, right? Understood? So this is a concern. This is a concern. You need to monitor fintech NBFCs. Now you have a new trend. So you can write it down that fintech NBFCs need to be supervised and regulated because they have a huge pie in these loans being defaulted below 50,000 rupees, right? Understood? Next, a blow up in NPAs here could pose indirect risk to the financial stability. Why are we concerned? Because if these elevated NPA are not checked properly, if they remain elevated actually, so that can pose a risk to financial stability despite the commercial banks performing well on their liquidity and capital adequacy fronts. So their efforts should not go in vain, right? This is the thing. Then as the NBFC is going big on these loans, are borrowers from banks and significant net debtors to the financial system. Why are we concerned? The author is saying a blow up in NPAs here could pose indirect risk to the financial stability, not direct risk, but indirect risk. Why indirect risk? So the author is saying as the NBFC going big on these loans, whosoever NBFCs are there who are providing these loans very hugely, continuously engaging in lending activities of these kind, they are borrowers from banks. They are borrowing from the banks and and significant net debtors to the financial system. They are borrowers and debtors into the financial system only. They have also borrowed from the banks. So if they borrow from the banks, what happens is, now even if the NBFCs default, the banking system will collapse. So it creates a risk to the banking system. Have you understood this? Now you understand why there is an indirect risk, because these NBFCs are also the borrowers from the banking system. So if their customers default, they will default, there will be a balance sheet problem in the commercial banks or the banking system. So finally banking system will get affected, right? And we do not want that. क्या चल रहा है आप लोगों का? Okay, so please no personal chats, just focus on the class. ये सब आप लोग बाद में डिस्कस करना, okay? And होमवर्क वगैरह की जहाँ तक बात है तो मिलता रहेगा. Is no single person is responsible for that. Solely I am responsible, okay? If you have to say something, you can say something to me only. So have you understood till this point? Tell me. Yes or no? This is the entire analysis. Then the author says RBI has its task cut out in trying to balance this risk with need to push financial inclusion. So now finally author says that RBI has this task. You have to manage the risk in the NBFC sector, you have to manage the risk in the banking sector, because they are all interrelated. That risk that NPA can translate into bank's balance sheet. So there is this concern that RBI needs to maintain this equilibrium. You have to monitor these NBFCs, fintech and NBFCs on a verge of defaulting, as well as you have to maintain the liquidity, also at the same time ensuring financial inclusion. So this is the concern. This was, I think, hopeful for you, this editorial. You have understood all the concerns raised. So these should be, points in your critical analysis of banking systems liquidity, NBFC liquidity. You can incorporate these points in your answers, right? Any doubts from this editorial? Then we have the second one as well. So quickly tell me, any doubts from this editorial, or you have understood everything? Not understood or no doubt? Please specify. All clear? Okay. डर लग जाता है, ऐसे मत लिखा करो no, yes सीधा. Not understood. No doubts, I hope so, right? Okay. Very good. So this was this article. I hope it was interesting for you. Now moving on to the next article which we have. So this has been taken from Business Standard again of 3rd July. So there was no relevant article, there was these articles related to labor reforms and all these things, which we have discussed in the labor force participation rate and all those things in the report which was released. So this another article I found relevant for you to understand, to analyze. It has been taken from Business Standard. It talks about the investors' confidence. If you remember the news, we have discussed that Indian government bonds are to be listed in the JP Morgan's bond index. Yes or no? Yeah, rural consumption. But I have discussed with you urban rural consumption divide in one of the editorials, if you recall. Yes or no? We have discussed urban and rural consumption. I went through that article. No significant trend or pattern is highlighted. Whatever we have discussed in those articles, whatever we have discussed in those articles is only there. So there was not something important to be discussed. हाँ, पहले किए हैं तो जो भी कर चुके हैं वो I do not repeat. Okay, I want you to learn something new only. Okay. So you recall JP Morgan inclusion, right? We have discussed in the RBI annual report as well. So it revolves around that news. What is the news? That there is considerable enthusiasm among financial market participants over India's inclusion in JP Morgan government bond indices. So the author wants to assess whether this inclusion is only good or it has certain cons as well. So all the pros and cons related to it. All the pros and cons related to it. Index inclusion and the risk involved in this. So you should try to understand what can be the risk as well. First of all, what is it? What is the news? So there is considerable enthusiasm. You all know we all are very excited. All the investors are excited. Entire financial market has positive outlook. All the financial market participants are enthusiastic or excited over India's inclusion in the JP Morgan government bond index. Okay, JP Morgan government bond index. Why is this important? What is this JP Morgan government bond index? So this is an index, it tracks all these government bonds which are denominated in their local currencies, domestic currencies. It tracks. Now this is followed by a lot number of investors. So they follow it at a huge level. That increases your credibility, that increases confidence into your financial market, right? That's why it is important. Now we all are very happy that okay, we have got listed into this. Last week India officially became part of the index which global investors widely track. So all the global investors, they track it actively and widely. That's why this inclusion is very, very significant. Yes, credibility increases. India's weight in the index will be increased by 1 percentage point every month till the cap of 10%. Also, this is significant because now JP Morgan has said they will increase India's weightage into this index by 1 percentage point every month. 1 percentage point every month until the 10% cap arises. So maximum it can be 10%. They will continuously increase India's weightage. That means we will represent more and more in the index. Our market, our bonds will be represented more and more. Having more weightage means what? Having more impact in the index, isn't it? Yes or no? Having more representation in the index, which is being followed by the global investors. So how much India's credibility is going to increase, you can assess from this information. So this is just an information analysis yet to come. Also, to authenticate this saying, author says that about $24 billion are expected to flow into India via this. $24 billion. In fact, the flows may be higher than this because non-index investors too may want to increase their exposure to India after its inclusion in the index. So the author is saying as per this inclusion in the index, it is expected that around $24 billion will come as inflow in India. Okay, that can be increased further. It can increase because non-index investors will now also want to invest in this because now credibility has improved. So who are all these non-index investors? Can you please tell me? Anyone knows that? Non-index investors. So you have index funds. Okay, they are also called non-institutional investors. They are generally non-institutional investors, right? No, you need not go into that much detail, kiski kam hogi, kiski zyada hogi. You just remember ki they are planning to increase the weightage of India's representation in the index, okay? There is nothing mentioned in the editorial about this thing as well. So we are not concerned about ki kiska share kam hoga, hamara बढ़ रहा है, that is good thing, right? So all these non-institutional investors will also want to invest. In that case, the value might increase beyond $24 billion. It's just expected. We can have more inflows. Now, why are we very happy about that? If you remember this thing, we have taken up in one of the editorials as well. Government is planning. So, government is excited because now they will have funds to fund their fiscal deficit, isn't it? Yes or no? Right? Understood. So, this is the thing. This is something related to the news. Now, coming on to the analysis part, so the author says, however, with inclusion in global bond indices and the intent to tap foreign funds to fund the fiscal deficit, it is worth noting that the process has both benefits and risks. As I discussed with you, why are we very excited about it? Because now we are seeing that we will have foreign funds, we will have extra funds. And those extra funds might be utilized by the government to tap, to reduce or to fund the fiscal deficit. But the author is saying that this is something which has benefits as well as risks. So this is a critical analysis kind of thing of India's inclusion. This is very, very important. You can note down all these points, right? What is the critical analysis? What are the benefits? What are the risks involved? So benefits, the government looks at it as a source of funds for funding your fiscal deficit. Now, what is fiscal deficit? You all know, when the total expenditure exceeds the total receipts of the government apart from the borrowings, right? And we have also discussed when fiscal deficit increases, how does it harm the economy? Because when fiscal deficit increases, government borrows more from the market. That leads to what? Crowding in or crowding out? Crowding in or crowding out? Tell me. That leads to crowding out effect or crowding in effect? Higher fiscal deficit. Yes, everyone out there? Crowding in? No. Crowding out. So I have discussed with you a number of times. What is crowding out? So when government borrows more from the market, less remains available for private borrowers or investors. That is crowding out of funds, right? Opposite is crowding in. In that case, what happens is money, the savings in the economy are being utilized to fund the borrowings, not for capital purposes, capital creation or investment purposes. This is harmful. In that case, investment activities in the economy will get affected. Production activity in the economy will get affected. You will have less capital creation that would harm your economy in the long run. Isn't it? So this is the question, this is a threat. This is a threat. But it seems as an opportunity for the government to have extra funds. Now, the author says it has both benefits as well as risks. So let's look into it. What are the benefits? What are the risks of India's inclusion in the JP Morgan bond index? Right? The increased flow into government bonds would reduce the requirement for borrowing in the domestic market, leaving domestic savings to the extent for domestic business. So this is the benefit highlighted by the author. This is the benefit highlighted by the author. What is the author saying? Author is saying that, you know, when government has more flows coming from the foreign funds, due to India's government bonds being listed over there, government will have sufficient funds that would require the government to borrow less from the domestic market in order to fund the fiscal deficit. You are catching up with me? Yes or no, right? So now government requires less to borrow from the domestic market. That would leave sufficient funds, extra funds for the private investors in the market to borrow from. Yes or no? Let me know quickly. Yes, so that would lead to now crowding in effect, opposite of crowding out effect. Sufficient funds will be available for private investors or borrowers, retail investors. Isn't it? So that would benefit your economy. So domestic businesses will have enough to borrow. They can invest into their projects. Capital creation will pick up. Investment activities will grow. Production will grow, employment will be generated, there will be growth finally. This is the benefit highlighted of this inclusion. But this will help, you know, this will help reduce the cost of money. Also, cost of money reduces. What is the cost of money? Cost of borrowing, interest rates. So if there are proper funds available, banks will not raise the interest rates, isn't it? If there are lesser funds available and many borrowers who want to borrow from that fund pool, banks increase the interest rate to earn profits, isn't it? Now when there is a lot of good amount of fund available, so banks do not have to increase the interest rates, rather they can lend more at the existing interest rates or maybe increasing nominally in order to earn profits. Also the borrowers will also will get the sufficient amount of loan amount at nominal interest rates. So cost of funds for them has reduced, then which would improve the investment outcomes and growth. You all know that. In that case, if interest rate reduces, you know that investment is a negative function of rate of interest. So if interest rate reduces, investment will increase in the economy, and once investments increase, production increases, there will be higher GDP numbers. These are the benefits. You should remember these points. These are the benefits. Then let's see what the author says. However, on the other hand, higher exposure to foreign funds can significantly increase volatility in the financial market. Now, what are the risks being highlighted by the author? We have seen the benefits, but there are certain risks as well. What is the risk? So, author is saying that, you know, higher exposure to foreign funds. If you are heavily dependent on foreign funds, that creates a risk, isn't it? Any economic crisis, any economic shock, any speculation which leads to fall in your weightage, your representation in that index, can significantly affect your credibility at the international level and can lead to capital outflows from your market, isn't it? Because after all, it is a stock market. It is something related to financial market which is risky. Yes or no? Investors might try to pull out their money if there is anything which goes against your credibility. So it creates risk for your economy, risk for your funds available with the economy, for capital inflows. You might witness capital outflow even if your weightage gets reduced by some percentage points due to any such kind of risk, unprecedented risk, right? To be sure, funds tracking indices tend to be more stable, but money can move out of quickly in the times of increased stress in global markets. Also, although these are not very volatile, these are fund tracking indices, right? So these are not as risky as the stock markets. They are just fund tracking indexes. But still, what can happen is, if there is any global market shock or any stress in the global financial markets, you can witness a capital outflow. Investors might pull out their money from these indices as well. This is the risk. Another thing, in times of stress, this can add to the pressure because funds from other instruments also tend to move out. So now you know what happens in the financial market. If there is even a single information which is a negative, which has a negative impact on the investors' confidence, not only what they have invested into these indices gets affected, but the entire financial market gets affected. They try to pull out all of their investments and then place them into a safer option, isn't it? Yes or no? So that creates a wholesome risk to entire financial market, not only concentrated to these tracking indices. Have you understood that, right? Any adjustment in India's weighting can also lead to sudden capital outflows. So we are very optimistic because now JP Morgan says India's weight will increase gradually. But due to any reason, if weight falls, if it gets reduced by certain percentage points, that would create a credibility question onto India's economy, India's financial market, and might lead to capital outflow from Indian economy. So that is a risk which should not be ignored. We should not heavily rely on these funds, although you can use them to finance your fiscal deficit, to fund your fiscal deficit, but there is a risk as well. Rather, you should have, you know, other funds to fund your fiscal deficit. You should increase your revenue generation from the domestic economy as well. Try to cut down on the unnecessary expenditures as well, right? So not very much dependence is good, but you can rely to a certain extent because there are risks involved as highlighted by the author. Also, the author says further, the index inclusion has come at the time when government is running a higher fiscal deficit and public debt remains elevated. This is something when we have higher fiscal deficit, isn't it? Our fiscal deficits are not within the desirable limits of 3% of GDP as per the FRBM Act. What is the present fiscal deficit? Around 5.9% going on, right? It is higher. So when you have higher fiscal deficit, try to understand this. When you have higher fiscal deficit also puts a question mark on your fiscal policy, also puts a question mark on the credibility of the government, credibility of the investment ecosystem going on, credibility of the financial market. So this again poses a risk which can affect India's representation in the JP Morgan Global Index. Then the author says, according to International Monetary Fund projection, India's general government budget deficit is likely to remain at 7% of GDP or above at least till 2027. So IMF forecasts, IMF data shows that, you know, India's GDP, India's fiscal deficit as a percentage of GDP is expected to be 7% or above 7% till 2027. So you see, if there is higher fiscal deficit projection, that reduces your credibility of the government and the country as a whole, isn't it? So that can be a risk. It can create a risk of your representation being reduced in the index in the future course of time. So risk is not something, you do not have these indices, listing of India's government bonds in the indices which are risk free. No, there are these kind of risks involved. Then sustained higher deficits and public debt can affect investor confidence, and if investor confidence gets affected in future, you have to bear the brunt if you rely heavily on these foreign funds, right? So it is thus important for India to reduce the general government budget deficit at a faster pace. So now you see why fiscal deficit reduction is important. It has that much influence. It is responsible for investor confidence in the financial market as well. So it is not related something only to the formula total expenditure minus total receipts. It has far-reaching complications and implications at the national level, at the international level. Have you understood that? Right? That's why we continuously keep on having pressure on the government, pressurizing the government to reduce the fiscal deficit. It has implications in all these sectors, be it financial market, be it domestic market, money market, banking system, anything. Finally, GDP growth, right? Then the author says that one big constraint for the government is that economic growth is driven largely by government expenditure. Why government is not being able to do that? Despite knowing all these implications, negative consequences we can have of higher fiscal deficit. So you need to understand why government is unable to meet the targets. One of the reasons highlighted by author is government expenditure. The growth is driven by government expenditure. You cannot cut down on that. Are you getting my point? Yes or no? Anyone there? Okay. So if you cut down on the government expenditure, which is a constituent of your economic growth suffers. After all, there will be no point of reducing the fiscal deficit if you are unable to grow at higher numbers, right? So this is a concern. So what is the solution to this problem? Tell me. You need to have private investment as much as possible. The growth should be driven by private capital expenditure, private investment, isn't it? That should come from domestic as well as from the foreign sources. You need to diversify your revenue of investment funds. Are you able to understand that? Right? Next, however, at some point the government would need to start borrowing less and make way for the private sector. So you have to make way for the private sector. Now you see, this irony going on. Are you able to find out this thing? This irony. What is the irony? What is the irony? Try to understand. We are saying government has higher fiscal deficit, so government is borrowing more from the market, so less is available for the private sector. Now when private sector borrows less, they will be able to invest less, and government the growth in India is government expenditure driven. How to solve this? So the root cause is higher fiscal deficit. You will only able to derive your growth from the private investments when you have enough funds available in the market for the private investors to borrow from, isn't it? So the final answer comes out to be reduction in the fiscal deficit. You have to have crowding in effect rather than crowding out effect to resolve this problem. So there is this problem arising out of the problem of fiscal deficit only. So the root cause is fiscal deficit, right? Otherwise, India's economy is performing well on all other macroeconomic indicators you see. From the RBI report, we have seen that, right? In sum, so finally the author says that, okay. Finally, the author says, to boost investor confidence, including foreign investors, it is important that India not only achieves higher economic growth, but also maintains a low and stable fiscal and current account deficit with price stability. So the conclusion of the analysis is that, fiscal deficit, why are we crying? So every then and there you see everyone is pressurizing the government to reduce the fiscal deficit. So now if they ask you, any examiner asks you in interview, they ask you, why are we so concerned about fiscal deficit? What can be the implications? You can explain all these things. Yes, crying literally, right? So we can explain all these things, that it has something to do with the investors' confidence as well. If you need to maintain investor confidence into India's financial market, you need to cut down on your fiscal deficit, have price stability, have reduction in current account deficit, which we are doing. So from the RBI annual report analysis, India's current account deficit is narrowing, isn't it? Right? So we are on a course of correcting all these performances, but still a lot needs to be done, right? Okay. So this was the analysis of the second editorial. I hope you found it interesting. You have understood this entire thing, right? So there is risk involved. You need to keep in mind the risk, but there are benefits of India's inclusion in them as well. Yes, khatam. Okay. Any doubts so far from today's analysis? I hope you found them interesting. Got to learn something out of them. Any questions, any doubts? Or shall I wind it up now? No doubts? Alright. Thank you so much for being focused and interactive for a longer period of time. It takes time to analyze these kind of articles. I just cannot leave you with questions in your mind. Okay? But anyways, it will be helpful for you. So this is not a waste of time. This is investment which you are putting in for your result. Okay? This is investment. Alright. Thank you so much. I'll see you in the next session, in the next class. Till then, have a good day. Thank you so much.